Welcome. How's everyone going? First up, long time, dead tired, forget about it, hospital a lot. That's the summary. I'm going to give you a little bit of a market update, all right? So, been working on a lot, not having much sleep. Big things coming. If you can just remain patient, I got big things coming. Uh, let's do a market update, okay? I don't have the energy today to do any sort of education, if that makes sense. Okay, so we're just going to focus on the good old market updates. As always, not financial advice, just showing you how I study Gann and how I study price action. So we'll start off with American markets, okay? American markets. Now, I have a question for you, and this is a good question. I suppose it's a two-part question, yeah? So at what point do you deem Gann invalid? Okay, so what actually has to happen in the market for you to deem it invalid? And the second point is, would you have been able to forecast yourself a June high or even a potential July high in the US markets? They have the old saying, sell in May and go away. We know that May produced a lot of upside, and then potentially everyone sold and went away. But that's not going to be the case for every single year. And if we go through last year, for example, sell in May and, oh shit, we better fucking stay. Okay, so it doesn't actually occur every single year. So is there a point in time, or is there an ability to forecast price action in a way that you can? Now, I never aim for 100%. I never suggest that you can aim for 100%. But there is one thing I do say: if you have the right cycles, all you need to deal with is inversions. And what do I mean by that? And I say it a lot, and then I'll show you the chart. So don't stress out too much. Yeah. Let's just do it on here. Okay. I'm gonna get a little bit of a pencil up. PENC. And so if we have the right cycle, let's just say that our cycle was producing a curve like this. And I'll show you a curve soon. Now, what do I mean? Well, if we have the right cycle, all we have to deal with inversions. Let's just say that this is what price is doing in a suggested cycle curve, okay? Perfect. Okay, so we have the cycle, which is the solid line, and then we have the price action, which is the squiggly line, and it somewhat followed the cycle. It might not have been perfect. It might have screwed it down further than the cycle suggested, and then overshot it, and then undershot it, and then overshot it, and so forth. But there are going to be times when you are going to be dealing with an inversion. Now, what does that actually mean? Well, I'm going to draw it out, and I'm going to draw it out. I'm going to delete this one, and I'm going to draw a little curve again. Okay, this is our curve. Now, if we're dealing with an inversion, what it can look like is like this, right? So cycle's moving up, and then it moves down a little bit, and then it kind of moves up, and then it moves down. Okay. So you can see that basically, if we look at our inflection points, price merely inverted that price action. And then as it came out of that inflection point, what often happens is the next run is typically inverted. So there's going to be a time point where price is going to invert the forecast. Now, for a lot of people, when they study Gann, they'll think that the forecast was wrong. Okay, so they'll see the pressure chart or they'll see the forecast and they'll go, "Oh, price actually moved up and now down. It's actually incorrect," and they'll write it off. They'll never learn how to forecast. Well, if we actually look at it, and if this curve actually goes on, for example, and what might actually happen is price might come down a little bit further, maybe hit an inflection point here, and then it'll sync up again. And it's this whole move that they write off the whole year. I never want you to write off the whole year, because if you have the right forecast, all you need to deal with is inversions. And that simply means that flipping the forecast, okay? Flipping the forecast and everything syncs up again. And you only need to flip it for the time period that the market is inverting. Now, as an example, I suggested, and I've written about, and I assume most people publicly know, that I am slightly bearish after a potential April high. That was the suggested forecast. So that you can't run away from that. That's what we put out. So we're looking for a potential March low April high, and then that was kind of meant to be the forecast. However, you can see this trajectory lower actually had a trajectory higher. Now, if we look at the Aussie market, I'm going to give you the Aussie market right now. Let's get this up. This is where I keep all my folders and everything, All right, open workbook. Because the Aussie market's a good one to show you where the US markets and the Aussie markets went differently. So if we look at our actual forecast here, okay, let's go full out actually. You can see actually it was pretty good forecast for the year. So markets rising into the start of the year, falling into March, rising into April, and then falling since. And what do I mean by falling since? Well, they haven't actually fallen since. They've been going basically sideways due to the rising of the US market. So nothing is totally collapsing. However, getting these kind of curves tells you when you should be in and out of the market. Now, to get back into the market, we'd probably be looking for around August to September time period. So the actual curve low comes in around this time period, and then we'd be looking up again. It can just be that price action trades sideways, follows its kind of curve, but in a sideways motion before it trajects higher again. And I say that because the end of the year forecast for the Aussie market is actually up. Now, if we go out a little bit and we see what's actually happening in the curve here, you can see kind of this same trajectory. Okay. Now, we always mix the US markets with the Aussie markets. We always use the US market as the primary curve because it is like the big brother. When the big brother gets sick, the whole family gets sick. Or when the father, no, not so much the father, but anyway, the idea is that we use a top-down model of forecasting, and we try to get an understanding of what the US market is doing, and then we can kind of project what the Aussie market is doing and other world markets for that example. So, we sell at after the first 2 months, and then we're going to be looking for the market to fall. How do we forecast the exact day lows? Well, that requires another model. The mass pressure chart's not going to give you that. You need to use models like time by solar degrees, for example. Um, this is how you become a good forecaster. It's overlaying the models and getting those areas where things actually bottom out or top out. And we also use the McWhirter method during this time period. As we moved into the low, we were relying heavily on the McWhirter method. Not so much now, just because we don't need to. Price is actually trading sideways, so we've dropped that model just at the moment. It's good for your intra-week, intra-month sort of turns, but we don't need it for the longer-term forecast. And then the forecast suggested high prices into potentially April. And we did suggest a mid-month April high, which actually occurred, and that's based on time by solar degrees. Markets moved down just as the forecast has come down. Now we're into this kind of low point here. Okay. Now you can see that the low point is suggested around mid-July. Okay. Mid to end July. We can tell that price is currently trading sideways and it's not really showing any signs of death. However, if we really want to get technical, what we should be doing is we should be offsetting this, and we should actually be matching up as much as possible the major low, if possible. It's not always going to be possible, but if possible, that's what we should be doing. If we don't have the ability to do that, and all we can do is match up the highs, then what we do is match up the highs, but we know that we have not much synchronicity here, and price isn't really respecting that. So I would probably go forward around that 20-day period and match up those lows. So that is how you deal with inversions. Now we're going to take a look at the American market. Because I have to ask, was there any telltale signs that the US markets were going to roll over? Now, at the time, the Strait of Hormuz was open, the war was meant to be dropped, all this sort of good stuff in the world, yeah? So all that sort of stuff was over. When we look at the actual forecast, though, we can see that the forecast for July was to top out around the 6th to the 7th, and then to trend lower. And as you can see, it actually does trend lower into August. We can see how the price rejected, moved down. It might move up. Oh, we actually have a weekend here, so it might bypass that, but it might move up on Monday for a couple of hours or 1 or 2 sessions, and then it's likely to traject lower again. Forecasting, okay? It's not that hard once we have the cycles. Now, what about, let's go in and let's take a look at June, for example. What about forecasting the month of June? A lot of people didn't see that start of the month low Okay, this is something that we put out. Okay, so prices are going to trade higher for a little bit, and then they're going to move into a low, and then they're going to move up. Now, there was meant to be a decline that occurred in the curve. Okay, so this was going to be another buy point. However, that occurred over a weekend, so it just bypasses that and continues its trajectory higher. When we do the next month's forecast, we go, okay, well, there's potential for topping around the first or the second week. We can see that a lot of this energy is waning. Okay, and then after that top, we're looking for prices to sell off. Once you learn the skill of forecasting, which is something that we definitely do teach at the International School of Forecasting, a lot of these moves start to make sense. Now, you're not always going to get every single curve correct. You can see right here, and this is where we deal with the inversions. Price came down into this low, but didn't actually trend lower as the curve suggested to the trajectory that it suggested. In fact, we can see that price is moving up against it. And then it's coming into this low period, which is the actual curve low, and then it's sinking up again. Okay. So the low came in, price is moving up, stabilizing, and then falling. So learning how to interpret the curves is actually very important. We look at the SPX, for example, looking for a potential high around that 11th, this is a weekend, so we would have gone Friday to kind of Monday time period, looking for a potential high around here, and then a potential steep drop off. Again, potential steep drop off. Again, that would be now the forecast. As long as price doesn't invert, we may be looking for potential rally up for a day or two. This is over a weekend, so maybe a Monday spike, and then price is falling for about another week. Once you get the hang of this, a lot of it starts to make sense, especially when we put out the long-term forecast. Now, the long-term forecasts are also just that, forecasts. If we can understand what the potential trajectory is of the market at the time, then we can get a better understanding of the bias of the full year. But we know that sometimes weeks to months can invert. So if the forecast is extremely bearish for a whole month or a whole 3-month period, there is a chance that it can invert. Okay, and I just want to always stress that. I won't go into anything here. I'll leave that for those of you who are in the forecasting service. DAX is another good example. This is one that we were looking for a potential top around that start of the month too. Again, this was all written about. We said watch out for a potential top. Into the first or that second week, we're going out to a potential SPX high as well. But you can just see the trajectory. So this is from June. So market's moving down, market's moving up, down, and then up. And we just put these out every single month. Okay. Now there is chance that if the US market doesn't sell off now, that the DAX is going to come into its low, maybe make a double bottom around this point, and then move up into the end of the month before selling off again. So I won't give too much out. That is for the guys in the Forecaster, which is a monthly service that we produce. And we only open that once a year. So I'm not trying to sell you. Once it's open, you'll hear about it. Just let you know that's what we do. Now, the other thing that I have been doing is working with Go No Go, DVAN modules, ND research modules. I'm going to take a look at a few markets like gold, silver. I'm going to give you the update on Go No Go. And the maybe not DVAN, but we'll do ND research support and resistance levels. Now, these are proprietary models, so they will not be shared publicly. You'll need to buy a subscription if that's something that you are interested in obtaining. I did a ton of research for months on the potential curves that they were doing, and I kind of built my own model based on their models, which I believe is as close as we can get to the research that they produced. But unfortunately, you'll need to get a subscription if you want to actually use the model through Optima or whatnot. But I know that in TradingView, if you type up here and you go no go, you can actually find that there is plenty of models for these out there already. So we'll take a look at Dow Jones. We'll just do a broad market right now. Alrighty. So what you're looking at is two theories on your chart. The first one is the Go No Go, and it colors the chart. And it gives it a orange, pink, light green, and then sort of like a darker blue. Now, if you were a trend trader, what you'd be looking for is you'd be looking for the goes on the dark blue. That tells you that the market is in a strong position and is likely to rise. and that every time it goes dark blue, it generally produces a new buying opportunity. Just keep in mind that sometimes the oscillators being lagging that are being used can produce delayed entries. So it's always good to apply Gann's rule of three and actually buying into the dips instead of out of the dips. Okay, so Gann's rule of three will get you in lower as price moves down, and you'll also find that as price moves down, it also produces a different color change. So just merging everything together is actually beneficial. But when it's in go and it's in blue, we can expect prices to rise. When it's in purple and it's in no go, we can expect prices to fall. That is until the trend changes. So when the trend changes, it'll change color. Okay, you can see this out throughout the chart. Okay, so prices go down, they turn purple. Prices go up, they turn blue. It's actually a really good indicator, and I strongly recommend someone learning how it works and possibly even joining up and obtaining the subscription to it. The second one we have here is the ND research, and this is my version of it. It's not exactly the true version, but it provides us volatility waves. And from those volatility waves, we can actually obtain support and resistance levels out into the future. So we have a volatility wave down below, and we have a support and resistance zone down here. So if price ever came down here, our most recent or most major support and resistance levels around 43 to 44,000, clustering right here. We could also put a support and resistance zone possibly around 47 to 48,000 right in here. But basically, as volatility shifts in these indicators, it provides us a zone where support and resistance can come in. Now, if we actually look at price action, so the resistance zone from April, for example, in the volatility index, as price moved into this zone, it actually stalled. Okay, so it came up, rejected it, came up, tried to find support on it, but it's now rejecting it. So within this zone, price can reject. Now, it is a support and resistance zone, and that means that price can actually come into it, find support in it, and then bounce out of it. The red zone is generally considered resistance, and the blue zone is generally considered support. However, they can flip. If price is above it, it becomes support, and if price is below it, it becomes resistance. So, I believe I said that wrong. I don't know why I think I said that wrong. Anyway, if price is below it, becomes resistance. Price is above it, becomes support. Maybe I said that right the first time, but in my head, I thought I messed it up. So for the US markets right now, we're currently sitting, let's go ahead and refresh this. Currently sitting in this upper band resistance. We are flipping from dark blue to a greenish color or a light blue, aqua, whatever you want to call it. And price is moving below the support resistance. So it's not saying that price is going to crumble, but once it does and it starts to turn, we would then look at this 50,000, so 50,500 to 50,900 zone for potential support. One market that everyone is looking at right now is Bitcoin. So we'll just take a look at Bitcoin. And one interesting point here I want to make is that Bitcoin has actually posted its first go since May 2026. So it's actually spent basically 1.5 months falling, going through a transition period where it actually goes into a neutral zone where it changes color and just there's no direction, going into another no-go, so price was kind of pushing down again, then changing to neutral again, which is the orange section, and now pasting its first go for 2 months. The last time I did this, price rose. The time before that, we were in a sideways market, so price was dropping between go and no-go a lot. And price before that, again, we were also in a sideways market. So whether we're in a sideways market or not just yet, it's too early to tell. The price is transitioning to go, so the indicators are pointing up. Now, it is actually a model that works, and it works really well on Bitcoin. However, it works the best in strong movement markets, okay? And you can actually use it to catch a lot of the lows and run them into their sideways markets. Capture a lot of the lows, run them into the sideways. Capture a lot of the lows, run them into the sideways. So I'm not saying that it is definitely guaranteed. Just based on this, we need to use the mass pressure charts and we need to line up the planetary energy to get the full story. but I'm just trying to give you some price-based action information right now. So we're pitching go, which is technically bullish. However, resistance at 69,000, and if it moves at resistance at 87,000, and then below that, support at 55, 54, and then below that, 52 to 50. Next one that everyone is focusing on is gold. Going to take a look at that one. See right now, gold has been pitching a no-go since March, and it's still currently in a no-go, which just means that the way that I like to look at it is if you're in a no-go, you sell the tops. Okay, as the market moves higher into the light pink or light purple bands, you use those as counter trend rallies to sell, and then it transitions lower. As it moves higher, you use that as a counter trend rally to sell, then it transitions lower. And that's why I really like this. You take a look at the go zones. Okay, you can see that as price rises, you use the transition period lower to add. Price rises, transition lower to add. And as long as the trend continues, and that's why you'd have stop losses and or phase out as the no-go comes in, you just keep buying those lows. So the last lows that you would have actually bought around here, and it would have resulted in a losing trade because you would have transitioned to a no-go. However, this whole run here, you would have been allocating in. So gold is currently a no-go, which just means no buy. That's pretty much it. So we have our support and resistance on the chart here. And from the higher bands, we've actually got support and resistance up the very, very top. Okay, so there's actually a lot of congestion up at this old highs, which I do think that when the market does get up there, if it gets up there, it's going to make another spiky sell-off. Okay, we have seen this in the past a few times, where the market gets to old highs and then makes a spiky sell-off, such as around here. So this high in 2024, this high in 24, makes a spiky sell-off. So coming into those old lows again, so we go forward again, spiky sell-off might come down to that 4,000, into this sort of congestion area. Very plausible. Wouldn't write it off. Something to consider. Take a look at silver now. Silver's the one where everyone's losing money, and you can see that silver transitioned from go to no-go, so it went choppy for quite a while. It has been in a sustained no-go since May, and it's also turned support into resistance. So if we look in here, let's go ahead and open this up. This is our support zone, so price comes down into it, bounces out of it, and then it broke through it, hit it as resistance, and now it's falling away. If price does continue to fall away, and that's a big if it does continue to fall away, then we would look at this $48 to $45 mark as potential support zone. That's the most recent clustering area. Now, if we actually go back in time, we take a look, just get a little, wonder if I can draw in a rectangle for you. So this zone in here would have given us a prior support, okay, based on the volatility. Support zone in here, because we're using the upper band and the lower band of volatility to provide our support and resistance. Again, it matches up with this smaller zone. This one here also matches up with our smaller zone. So there's definitely major support in this area. And also down below, there's more support at $30. But you can see just in here how these volatility zones, when moved out into the future, provide us this clustering of where support and resistance is. And the most recent one, which you can obviously see, was this zone right in here, which we would have triggered just a couple of days after it actually activated and price found resistance in the zone. So these support and resistance zones are actually very, very interesting to be working with. But there are also some new studies. So I'm not fully aware of how they work intimately. From what I've seen, they're actually very important. And what I would be doing for those of you who are studying the Gann stuff is to make sure that your square of 9 level sits in one of these zones. You might get 1 or 2 levels in these zones, and I think that's going to be a fantastic support and resistance zone if you can get the volatility mixed in with the actual square of 9. So you've got the zones here. You can see I'm just going over them on my chart on the right-hand side. So just make sure you've got a square of 9 resistance level in these zones, and you might be able to find out that's around $64, for example, $63 to $64, provided a decent square of 9 level. It also came into this low over here, which I know, based on the square of 9, that there is a square of 9 level in this zone around that $64 mark. So merge everything. The more indicators that you have at one price point is going to be a stronger resistance level. Now, Gann is all about natural price and resistance, support and resistance, I should say. So it's not so much double tops, double bottoms, and things like that. It's square of 9. You might use price extension and retracements through the 8th harmonic, very similar to Fibonacci's, but using Gann's 8th harmonic for those who are familiar with that. And then here's your zones. Okay, so let's move on. Let's take a look at Bitcoin. BTC USD. Did we do this one? Can't remember. All right, if we did it, I guess we did do it. We're in a go zone. Dow Jones, and then we'll take a look at DAX. Let's see where everything's at, and then we'll close off. Dow Jones, we remember. Transitioning lower. DAX, final one. DAX index, yeah, that's correct. All right, the DAX index found resistance right at its support resistance band. So only spent about a day or two there and then rejected it. We have support all the way over here in March, which is activating as support, as you can see on the band and in price. So market came up, rejected it, moved above it, then found support on this exact band. So it's really, really helpful. Moved up into the first resistance band that it found. Also, if we go ahead and do what we did before, we'll know that support and resistance from these old zones actually activated as well. You can see just how it activates. Price bounces off it. So same thing, wherever these zones are coming in would give us more zones. However, these are smaller time frame movements and not the major pivots, which you can see are actually marked. So the major pivot for the DAX is actually around 20,000 to 21,000. And if that ever actually activates again, yeah, can't write it off. During a GFC type event, that'll definitely activate it again. It's not that far away. I believe I can. Stats, price range, 5,000 points, percentage change, 22 points. Yeah. So if on a major collapse, we'd probably be looking at like that 40 to 50% decline. That's a GFC sort of decline. So if you go back in time, there's a high chance that during a kind of major event, we would get that. We know that that happened then. Let's take a look if we got data to 2008. So top to bottom, the DAX fell around 55%. So if that the DAX can easily fall 50%. Now, if the DAX did fall 50%, we know that generally speaking, let's go ahead and do this one too. This one was a huge decline, 70%, 50%, 50% during COVID. And if the market ever did fall 50% again, it would generally be a good time to be looking for a potential reversal. Don't get scared. If the market falls 50%, you should not get scared, and you should definitely have your eyeballs on the market. And usually, if it does fall past 50%, you definitely look for the 8th harmonic on Gann numbers. So dividing the top by 8. Okay. So take the top number that occurred, so 8,172, divide it by 8, and you're likely to find one proportion that is providing some form of support or resistance. All right, so that's basically what I have for you in that sense. There's a lot going on here for sure, but just a market update. There's there's a lot going on. We've got the new learning tool that we have done for the school. So if you have a membership and you didn't like the way that the courses were delivered in the past, I have refreshed that. There's a new custom built learning management software. We've got a new charting software coming out, which is going to have a lot of studies, a lot of Gann studies in it. We're going to port over the Go No Go, which is found on TradingView. You can actually take a look at the source material. We'll port that one over. Just go to indicators and search Go No Go. Someone has ported it to TradingView, so we're going to port that over as well. But I definitely encourage you to, if you do have the means of actually buying the subscription to it. I think it's a fantastic tool with lots of oscillators and indicators and things like that. Also, DVAN, so divergence analysis. Definitely take a look at that. That's something that we use a lot as well in our forecasting and price analysis. And we've also got, so we've got the charting tool coming. New courses are being developed. A lot's going on. So I hope that this has answered some questions for some of you in what's happening with price at the moment. We see this recent sell off. When we merge the sell offs with the forecasts, we can tell that everything is happening as it should. Okay. Everything is happening according to time as it should. So, yeah, I'm going to close it off. Thanks very much. I'll talk to you soon.